Start with some opening remarks, and then we'll go straight to your questions. Governor, go ahead.
Good morning, and thank you for joining Senior Deputy Wilkins. Okay. Good morning. Thank you for joining Senior Deputy Governor Wilkins and me to discuss today's policy announcement and our monetary policy report. Ce qu'il faut retenir aujourd'hui, c'est que l'économie va prendre pas mal de temps à se mettre complètement de la pandémie. La Banque du Canada va continuer d'apporter une détente monétaire pour soutenir l'économie pendant la reprise. Our main message today is that it will take quite some time for the economy to fully recover from the COVID-19 pandemic. And the Bank of Canada will keep providing monetary policy stimulus to support the recovery right through the recovery. Before turning to your questions, let me say a few words about our policy discussions. Obviously, the Governing Council spent a lot of time discussing the current status of the pandemic and its impact on the economy. Simply put, things really depend on how the virus evolves. We're basing our outlook on some particular assumptions about the virus. We assume authorities won't need to reinstate the sort of extensive and widespread containment measures we saw in the spring. But we can expect successive waves of the virus to require localized and targeted restrictions. The need for these restrictions will ebb and flow and gradually diminish over time. We are assuming that vaccines and effective treatments will be widely available by about the middle of 2022. Finally, we expect the fallout from the pandemic will have some long-lasting effects on future economic growth. Nous comprenons mieux qu'au printemps les effets économiques de confinement et l'impact des programmes d'aide publique. Nous savons aussi que le virus sera présent encore un certain temps. Le Conseil de direction a donc décidé de revenir à ses pratiques habituelles et de fournir une projection de croissance et d'inflation dans le RPM. Mais il est important de comprendre que la projection repose fortement sur nos hypothèses à propos du virus. As expected, the Canadian economy bounced back in the third quarter as many businesses reopened. In fact, the rebound was a little stronger than we had anticipated at the time of the July monetary policy report. But we are still more than 700,000 jobs below our pre-pandemic level. To put that into perspective, peak job losses in the Great Recession a little over a decade ago were about 425,000. The current job losses are concentrated in service sectors, particularly low-wage jobs where physical distancing is difficult. That's why the income support programs put in place have been so important for the recovery. They have protected the most vulnerable and supported household spending, which has helped underpin the recovery in consumption. Housing activity also rebounded sharply in the third quarter as sales made up ground that was lost during the containment phase. But outside household and government spending, the economy has struggled. Investment and exports have increased, but are still weighed down by uncertainty and weak demand. Meanwhile, the Canadian dollar has been a bit stronger than we assumed in July, despite continued low oil prices. The Governing Council agreed the very rapid growth of the reopening phase is now over, and we are in the slower growth recuperation phase. We expect fourth quarter growth to be just barely positive, weaker than previously expected due to the resurgence in COVID infections. For 2020 as a whole, we expect the economy will have shrunk by about 5.5%. Looking into 2021 and 2022, we are projecting annual growth to average almost 4%, with household spending leading the way. Mais cette croissance devrait être inégale d'un secteur à l'autre et évolue en dents de scie. Certains secteurs de l'économie ne pourront pas rouvrir complètement avant qu'une vaccine soit accessible à la population générale. La reprise va donc se faire à une vitesse très différente selon le secteur. De plus, comme les taux d'infection vont fluctuer, l'activité économique vont continuer d'être affectées par les mesures de confinement et par la prudence des consommateurs et les entreprises. Les investissements des entreprises devraient rester faibles à cause de l'incertitude qui persiste et les exportations devraient progresser, mais lentement. Tout compte fait, le conseil de direction s'attend à ce que l'économie continue de tourner en deçà de son potentiel jusque dans le courant de 2023. Let's turn to inflation now, our mandated goal. The most recent CPI data came in at 0.5%, and inflation is expected to stay below the 1% to 3% target range until next year, until early next year. After that, inflation is projected to rise gradually but stay below 2% throughout the projection period. The Governing Council also spent a fair bit of time discussing longer-term issues. We know the pandemic is reducing investment and is likely to cause long-lasting damage to some people's job prospects. These forces will reduce Canada's economic potential. We've substantially marked down our estimate of Canada's potential to about 1% a year through 2023. I explained earlier how our outlook is highly conditional on the assumptions about the virus. Beyond these, it's also subject to several important risks. For example, it's possible that consumption could be stronger than expected if households quickly reverse the buildup in savings they've accumulated since the start of the pandemic. In contrast, an economic setback could lead to a sharp tightening of financial conditions, further slowing growth and inflation. The Governing Council sees the risks around the projection to be roughly balanced, but it's important to remember that we are operating at the effective lower bound for our policy rate, and inflation is well below target. So we're particularly focused on downside risks to our projection. Given our outlook, the Governing Council agreed that extraordinary monetary support will continue to be needed. Accordingly, we will continue to hold the policy interest rate at the effective lower bound until economic slack is absorbed, and so that the 2% inflation target is sustainably achieved. In our current projection, that takes us into 2023. We are providing exceptional forward guidance combined with a full economic projection to provide as much clarity as we can to Canadians in an environment of considerable uncertainty. Our forward guidance is being reinforced and supplemented by our quantitative easing, or QE, program. We are recalibrating our program of government bond purchases, and I want to take a moment to explain what we're doing and why. At the outset of the pandemic, our bond purchases were focused on restoring orderly market conditions, and we concentrated on buying bonds with shorter maturities where issuance was strongest. Now that markets are functioning well and the yields on shorter maturity bonds are well anchored by our forward guidance, we can concentrate more of our bond purchases at longer maturities. Shifting our purchases to longer bonds increases the amount of monetary stimulus provided per dollar purchased. That's because it focuses more directly on the borrowing rates that are most relevant for households and businesses. Given the expected impact from buying more longer-term bonds, the Governing Council judges that as we gradually reduce our total weekly bond purchases from at least $5 billion to a minimum of $4 billion, our QE program will continue to provide at least as much stimulus as before. This recalibration will increase the effectiveness of our quantitative easing program. Le programme d'assouplissement quantitatif va se poursuivre jusqu'à ce que la reprise soit bien amorcée. Nous sommes déterminés à procurer le niveau de détente monétaire nécessaire pour soutenir la reprise et atteindre l'objectif d'inflation. The QE program will continue until the recovery is well underway. We are committed to providing the monetary policy stimulus to support the recovery and achieve our inflation objective. With that, Senior Deputy Governor Wilkins and I would be very pleased to take your questions.
Thank you, Governor. We'll go to questions now. We'll do one question per reporter and then a follow-up in this first round. Please state your name and affiliation before asking your question. I will just remind reporters to mute their line if they're not asking a question. You can do so by pressing *6 and unmute by pressing *6 again. Avant de poser une question, veuillez vous identifier, s'il vous plaît. Libre à vous de poser vos questions dans la langue officielle de votre choix. Pour mettre votre ligne en mode discrétion, appuyez sur *6. Pour l'enlever, faites *6 encore une fois. The first question is from David Parkinson from the Globe and Mail, and this, excuse me, the second one is from Kim McCrail, Wall Street Journal. Go ahead, David.
Oh, hi, Governor Dave Parkinson at the Globe here. Wanted to ask you about the QE recalibration. Obviously, there have been some concerns expressed in from various people in the market about the size of the Bank of Canada's footprint in the Government of Canada bond market. As I think you pointed out in the MPR, it's up to about 35% of the total market now. I'm wondering how much of the decision to reduce to $4 billion a week from $5 billion had to do with sharing that concern about the growing size of the bank's footprint in that market, and if by reducing it to this amount, it will stop or even reverse that growth of your share.
David, this adjustment is about maximizing the effectiveness of the program. As I indicated, with our forward guidance, yields at the short end of the curve are very well anchored. We don't need to buy at the short end, and so we can get out of the way of the market at the short end and shift that to buying more longer maturities, and in doing so, increase the monetary policy stimulus from quantitative easing per dollar purchased, because we're targeting the interest rates that are most relevant for household and corporate borrowing. And at the same time, we can buy less because we're increasing the impact per dollar and still have just as much, at least as much monetary stimulus as we had before. I would underline that there is scope to do more if we need to do more. As you can see in one of the boxes in the Monetary Policy Report, our balance sheet, it has grown rapidly, but it remains much smaller than a number of other leading central banks relative to the size of our economy. So there is scope to do more, and if we need to do more, we will do more.
Dave, do you have a follow-up?
Okay, just to follow up, because we didn't really get to the question I asked. Are you concerned about the size of the bank's footprint at 35% and growing, specifically in that market?
David, when we first announced the programs, we were very clear that they would be adjusted. They would be adjusted in light of market conditions. And one of the key principles was that we want to maximize the economic impact of our programs. So we want to buy in the range of maturities that maximizes the economic impact. This recalibration is about increasing the effectiveness and maximizing the impact.
Thank you. The next question is from Kim McCrail of Wall Street Journal, and she'll be followed by Shelley Hagan of Bloomberg.
Thanks. Governor, I'd like to ask if you can comment on what was behind the decision to provide some more explicit forward guidance in today's announcement. What led you to come to that decision, and what impact do you think putting a more specific time frame on keeping interest rates at their current level will have?
Well, maybe I'll turn to Ms. Wilkins to start and say a few words about our discussions, and then I'll come back and add a little more. But why don't you start?
Sure. Thank you, Governor. So the discussion about the forward guidance was quite robust within Governing Council. It took a while because we were really concerned about were focused on what are we trying to achieve with this. And we all agreed that at a time of uncertainty for Canadians, that it was really important to be as clear as possible about how we saw the outlook and what that might mean given the outlook for borrowing costs that are very important to Canadian households and businesses. And so in that regard, we wanted to underscore, yes, we have a recuperation phase, but it's still going to take time to get back to square and to get into a situation where inflation is sustainably at target. And that it would be beneficial for Canadians as well as market participants to know, related to our forecast, when that might happen. And so that's really what underscored our willingness to be as clear as we were. And, with respect to any particular market reaction, markets take what they'd like from it. Really, our primary goal was to provide the clarity to Canadians about what they could expect so that they could have more confidence, at least in some areas, of their finances.
And I'll just add that, we spent a lot of time discussing the evolution of the virus and how that would affect the economy. Monetary policy, can't provide a vaccine, but it can support the economy through the length of this pandemic. And once we have a vaccine, make sure the economy gets back to its full potential. And in providing that forward guidance and indicating that we expect that'll happen sometime in 2023, we're really being as clear as possible to Canadians.
Thanks. And I'd also like to ask if you discussed any potential downsides of providing that further clarity in terms of the time frame when you think rates will still remain low. If the economy evolves better than you've anticipated, interest rates are sustainably on target faster than expected, have you tied yourself down to some extent with the way you've worded the statement today?
Well, we go out of our way to underline that there is an unusual amount of uncertainty around that projection. And we certainly will be updating our projections as things unfold. But we do think it's important to be as clear as we can about how we see things today. That will help Canadians make the decisions that they need to make.
Before we go to the next question, if there are any reporters who joined the call late and you have a question, please let us know by sending a quick email to communications@bankofcanada.ca and we'll put you in the queue. Pour les journalistes qui se sont joints à l'appel avec un peu de retard, envoyez un bref courriel à communication@banqueducanada.ca si vous souhaitez poser une question et on ajoutera votre nom à la liste. So the next question is from Shelley Hagan of Bloomberg News, and she'll be followed by Greg Quinn of Market News. Go ahead, Shelley.
Good morning, Governor. I wanted to ask about news this month where Conservative lawmaker Pierre Poilievre cautioned the central bank against financing Justin Trudeau's spending plans beyond the immediate pandemic emergency measures because of any political implications. I wanted to know what your thoughts are on this.
We've been very clear from the start, as we've taken these exceptional measures, that they are focused on achieving our inflation target. And today, we've, as we just discussed, we've reinforced our forward guidance, indicating that in our current projection, we don't expect slack to be absorbed until sometime in 2023. We've recalibrated our quantitative easing to increase its impact while reducing the overall amount of purchases. Those actions were taken to provide the stimulus that we think is needed to get inflation back to target. That is what's guiding us.
Okay, and as a follow-up, I wanted to ask about what does shifting your QE program toward long-term bonds means? What maturities? Is this 10, 15-year, and does it extend as far as 30-year bonds?
So as I indicated, the purpose of shifting is to really improve the efficiency and the effectiveness of the program. By buying more at the terms that households and companies typically borrow at, we can have a bigger impact per dollar of purchases. So if you look in the monetary policy report, you can see a lot of our balance sheet is under 2 years. We will be shifting to 3, 5, 10, 15, some at 30 as well. If you look at where households and businesses borrow, those are the maturities where they typically borrow. And by targeting those, we can lower the term premiums that they borrow at and increase the effectiveness of our program. So this shift will, we've lowered the minimum purchases to $4 billion. As we shift the purchases to longer maturities, we will be reducing the amount, and that'll be gradually phased in over a number of weeks.
The next question is from Greg Quinn of Market News, and he'll be followed by David Aiken of Global.
Good morning. I'd like to ask about the idea of scarring in the economy. Is this scarring turning out to be much deeper than a traditional recession, and is it going to be a factor in making the recovery that much longer?
Well, as I indicated briefly in my opening remarks, we did revise potential output, and I'm going to ask Ms. Wilkins to say a few words about our revisions to potential output, and clearly the scarring is a big factor in those revisions.
Thank you, Governor. Absolutely, and that's the bottom line to your question. Scarring is a factor that we're looking closely at. What can happen in a recession, and it happens in every recession, is that some people become unemployed and then get back to work quickly when the economy recovers. But there can be others that are left behind, and either because they become discouraged and they leave the labor market, or because they just don't have the skills for the jobs that are being created. And in this recession, and the governor's talked about this, it's fallen on the shoulders of those in lower incomes, tend to be in the high-touch sectors that have been closed, and tend to be women and younger people, although men are also affected. And so what we've tried to do is think about how many of those people may just take longer to get back. And in our new estimates of potential output, which you can get more details on in a paper that's going to be released on our website, we've assumed that a fraction of these people are permanent. And that's because with COVID, not only is the recovery going to take longer, so there's more chances there'll be scarring, it's also that the types of jobs that will be created because we're moving more to digitalization, it may just take some of these restaurants or high-touch areas may never open again, or at least take a long time, that it's going to take time for people to change sectors and get new skills. Now, that being said, we do expect employment to continue to grow and to the economy to get back on track. It's just going to take time, and we'll get back to a lower level than we would have had without COVID.
Thank you. Secondly, on the QE or asset purchases, other central banks have never really completely wound QE back from the last downturn a decade ago. Do you think that Canada will be able to completely get its way out of QE when the pandemic lifts?
Well, I think we're pretty clear this morning that the exit is some way off. By making our program more efficient today, we can actually buy less and provide just as much monetary stimulus, at least as much. Looking to the exit, we've indicated that this QE program would continue until the recovery is well underway. And that's clearly some ways off. What I would say, though, more broadly is that, in a world with lower potential growth, in a world with a lower neutral rate of interest, we can expect that central banks around the world are going to be hitting the effective lower bound more often as we go through future cycles. And so we are going to have to think more about how to both use these programs when we need them and unwind them when we don't need them. That's not the problem for today. Today we need them and we're using them.
Thank you. The next question is from David Aiken of Global TV, and he'll be followed by Jordan Press of Canadian Press. Go ahead, David.
Okay, just testing you can hear me. It's David. Have you got me?
We got you.
Okay, good. Thank you very much, Governor and Deputy Governor. Earlier, you were both asked about the rationale behind the extraordinary forward guidance. And Deputy Governor, you said so Canadians can have more confidence in some areas of their finances. And Governor, you were talking about this will help Canadians make decisions that they need to make. Given that the savings rate has skyrocketed, I wonder if I can read between the lines of what you said, that you're telling households, listen, don't worry about interest rates going up. If you need to borrow to buy a capital asset, a car, a TV, borrow to make the bills, it's okay. The bank has got your back for the medium term, at least, to keep rates low. Am I sort of right in interpreting that you're giving households the green light to maybe borrow a bit to get through this?
What we're saying is that we're going to get through this, but it's going to be a long slog. And we're telling Canadians, and our forward guidance has been very clear, that we're going to hold our policy interest rate at the effective lower bound until slack is absorbed, so that we can sustainably achieve our 2% inflation target. And we've indicated that's not going to happen into some time into 2023. So what does that mean? Yes, it means that if you're a household considering making a major purchase, if you're a business considering investing, you can be confident that interest rates will be low for a long time.
Great, thank you. And just switching gears slightly here. So just assuming our economy is built on three pillars. Oh, sorry, go ahead. Did you finish?
Yep, back to you.
Okay, sorry. Thank you, sorry. Just assuming our economy is built on three basic pillars: household spending, business investment, and exports. I wonder if you might give us your thoughts about which one needs more love and attention from policymakers, and similarly, whether or not whatever one you choose there needs more love and attention from fiscal policymakers versus monetary policy versus the bank. In other words, I'm trying to get a sense of, how much the bank can do and how much our economy would be looking to, as they say, the government, to fiscal policy, to whatever sector you think needs more love and attention there.
Well, you won't be surprised I'm going to stick to monetary policy. We're, in the report, we're quite clear that we expect that the recovery will be led by consumption. We've actually seen as the economy reopened, we saw a very strong rebound. We expected a very strong rebound. It was actually even a little stronger than we expected. It was very much led by consumption. And going forward, we expect consumption to be the leading driver of the recovery. Investment, we expect, is going to remain weak. Companies invest because they have an expectation of a future return. In an environment where there's a lot of uncertainty, in an environment where there's likely to be a fair amount of structural change because there's going to be some permanent effects from this pandemic, companies are hesitant to invest. Exports, the recovery in exports is going to depend a lot on the recovery, particularly the U.S. economy and more broadly the global economy. U.S. has also rebounded strongly, but we expect the U.S. recovery is going to be considerably slower from here. So the recovery in exports will be pretty gradual. And we also noted in the report that the Canadian dollar has appreciated a bit since July. and that will on the margin weigh on our export profile. So that gives you a sense of where what parts of the economy will lead the recovery and what parts will lag.
Next question is from Jordan Press of Canadian Press, followed by Julie Gordon of Reuters. Go ahead, Jordan.
Good morning, Governor and Senior Deputy Governor. Thanks so much for your time. I just want to pick up on something that David asked, and it has to do with the fiscal response that you have mentioned in the NPR. In the NPR, you talk about how, given some of the timelines about when you expect the economy to recover, there's a mention in the NPR that you expect that the government, the fiscal authorities will provide important support to the economy throughout the recovery. And so I'm wondering if you can just maybe provide a little bit of clarity here. Does that mean that that some of the assumptions in this NPR and in your outlook rest on the government continuing to provide aid, not just this year, next year, but maybe into 2022 and possibly into 2023?
So the convention in our projection is that we include everything the government has announced, and then there's a bit of a kind of a smoothing as those come off that's built into the projection. That is certainly an important element of the projection, and as we go into some depth into the report, and as Senior Deputy Governor Wilkins highlighted, the effects of this pandemic are extremely uneven. There's a particularly stunning chart in I think it's chart 10 in the Monetary Policy Report, which shows that for low-income workers, they're still about 20% below where they were pre-pandemic. Other workers are actually back, their employment is actually back to pre-pandemic levels. So the effects of this have been very uneven. I think that underlines the importance of the income support programs that the government has provided to protect the most vulnerable, and that has underpinned this recovery that I talked about in consumption. We will leave to the government decisions on future fiscal policy, but we've certainly built in everything that's been provided into our projection.
Okay, thank you for that. And just as a follow-up, there is mention, the NPR talks about this concern, and you have mentioned it, this concern about case counts rising, lockdowns and restrictions coming back in, potentially affecting near-term growth. And I'm curious if you can just explain what that means as far as jobs, as far as businesses that are just hanging on. Is it that you are not just so much as concerned about the ability for people to afford their bills, or sorry, to afford, let's say, Christmas, as they are so much to afford their own bills?
Well, clearly we are seeing a resurgence of the virus. It's happening in Canada. It's happening elsewhere. As we've indicated in the report, after a very strong third quarter, we always expected fourth quarter growth would be a lot slower than the third quarter. With the rising number of COVID infections, we've taken something off that. So our fourth quarter GDP growth is now barely positive, 0.2 quarterly or 1% annualized. Hopefully, as we come through this second wave, things will pick up again. But what we tried to outline is that we expect there will be successive waves of this pandemic. Hopefully, each wave will be a little smaller. We'll get better at managing them, and that's what's built into our base case. We also assume in our base case that we don't get, vaccines aren't widely available until middle of 2022. It could happen, that could happen faster. That would be wonderful. There are certainly scenarios where a vaccine is available early next year, and it proves effective, and we can deploy it at scale so that by the end of the year, we don't need to physically distance anymore. On the other hand, there are scenarios where the early vaccines aren't as effective as hoped. There are scenarios where a second or third wave is worse than expected. And so, the assumptions that we've made underlying our outlook try to balance these various possibilities.
Next question is from Julie Gordon of Reuters, and she'll be followed by Tony Mace of Mace News. Go ahead, Julie.
Hi there. Thanks for taking the questions. So you've now said that the output gap will not likely be closed until 2023, and which rates will stay low into 2023. Just to put a timeline on that, does that mean that interest rates are likely to be at the lower bound for a full 3 years now? Is it less than that, more than that?
Well, I think we've been pretty clear in our forward guidance. We're saying the policy rate will be at the effective lower bound until slack is absorbed so that we can sustainably achieve our 2% inflation target. And we're saying, based on our current projection, that all happens sometime in 2023. So yes, sometime in 2023.
Okay, and a follow-up, did you consider dialing back your 2022 forecast, and why was that one not changed?
Did we consider? Okay, so yes, you're right. 2022 is roughly what it was before. So, I mean, in terms of the profile, growth for this year, which is a contraction of 5.5%, that's actually less severe than we had at the last monetary policy report, because the bottom was a little higher than we thought it might be, and importantly, the recovery in the third quarter was stronger. So that's getting us further back more quickly. On the other hand, moving forward, we do think that growth from here, it's going to be tougher from here. So growth slows down. So we took a bit off 2021, and then by the time you're back to 2022, the faster recovery at first with a bit of a slower profile, we're back to roughly the same level. So the forecast for 2022 is pretty similar. I'm not sure how well I explained that, but I did my best.
Okay, so we may have a few minutes. There's still a couple more people on the queue, but if anybody has a question that they still haven't had a chance to ask, or if you joined the call late, reporters, please send us a quick email to communications@bankofcanada.ca. Pour les journalistes qui se sont joints à l'appel avec un peu de retard, il y a une question pour le gouverneur ou le premier sous-gouverneur. S'il vous plaît, envoyez un bref courriel à communication@banqueducanada.ca. And with that, we'll go to Tony Mace of Mace News.
Thank you, Governor. Back on October 8th, you spoke about stability concerns that keeping monetary policy so easy might contribute to those worries. I mean, how do you see those concerns now, in particular as it relates to the housing sector? And how does that affect your monetary policy thinking?
Yeah, perhaps I'll ask Ms. Wilkins to say a few words on that question.
So when you look at the housing sector, we've noticed, and I think everybody has, a very strong rebound. And of course, that rebound was expected just by virtue of the fact that the housing markets, for at least the resale market, was pretty much closed in the spring. And so there were a lot of people that would have wanted to buy a house that just didn't have a chance, and then jumped into the market. But at the same time, it's true that lower borrowing costs are helping make that leap more affordable. And so monetary policy is contributing to the strength in the housing sector, as monetary policy should. That's how monetary policy works. The financial concern would be whether or not the mortgages that were being taken on were not affordable in the long run, in the sense that the loan relative to the income was just getting too high. And we've talked about that in the past. Now, where you look at the particular strength in the housing market, it's in areas like Ottawa and Halifax and Montreal where the loan to income ratios are pretty low relative to the rest of the country. The other thing that we're watching closely is looking at, well, are we seeing shades of what we saw in 2016, where in particular urban centers like Toronto and Vancouver, there was a lot of speculation and price growth was reflecting what we thought were extrapolative expectations. And of course, right now, we're not seeing any of that. In fact, what we expect is that rebound, to the extent it reflected pent-up demand, will ease off a bit. And that just makes sense because the recovery's going to take some time, as the governor has said, as well as the fact that some people that tend to buy new houses, like younger people, may just take longer, especially to the extent that they're still finding their feet in terms of jobs. And so immigration as well, at least for the shorter term, will be slower. That will also create less demand than we would have had otherwise. So all those factors, for us point to something that we need to watch, but clearly not a major concern right now. And I would just say that monetary policy does work by creating an environment where businesses and households can borrow. And it's the underwriting practices, it's the macroprudential environment, the microprudential regulations that really are there as the safeguards to make sure that borrowing is of good quality and stands the test of time.
Tony, do you have a follow-up?
No, that's fine. Thank you very much.
Okay, well, it looks like we have time for one more question. And so going to the second round, I have Dave Parkinson.
Oh, just demuting. Thanks again. I'll go quick. Governor, back earlier in the month, you also were asked a question following your speech about possible tools in the toolbox, including negative interest rates. And you used a phrase with regard to negative interest rates, never say never. I know that you said other things before you got to never say never, but regardless, various people in the marketplace latched onto that phrase as possibly telling us that you might be more open than we previously thought to the notion of negative rates. Can you maybe just clarify where the bank stands on the topic of negative rates, and if that did come up in the discussions with the Governing Council in the deliberations?
Well, I think we've been very consistent on our comments around negative rates. In fact, one of the first questions I got at the press conference where I was being appointed the governor, I indicated that negative interest rates are in the toolkit. In the current situation, it's not something that we think would be very helpful, in fact, could be disruptive. But it is in the toolkit, and if the situation were to dramatically change, it is something we could consider, and that's what I meant by never say never. The bar would be very high to do that, and it is not something that we are currently discussing. It is not something we discussed at our most recent policy deliberations. So hopefully that clarifies it.
Thank you. So that
It does. Thank you.
We are actually out of time. Thanks. So that concludes today's press conference. Thank you to the governor and senior deputy governor and to all the reporters for joining us today.
Thank you.